Let's unpack this together. Between 2026 and 2040, we are witnessing what might be the greatest financial power shift since Bretton Woods collapsed in 1971. China is not just challenging the dollar. They're systematically building a parallel financial universe designed to operate completely outside Washington's control. And before you write this off as another sensationalist headline, I need you to understand something crucial. The banks, the Fed, the financial media cheerleaders, they've been telling you the dollar's dominance is untouchable, ordained by economic law. They're lying to you, not because they're necessarily evil, but because the truth threatens the very foundation of their power structure. I've spent 2 decades watching currency flows, and what I'm seeing right now is unprecedented. The moves Beijing is making aren't the desperate flailing of a rival economy trying to punch above its weight. These are calculated multi-decade chess moves executed with surgical precision by people who think in generational timelines, not quarterly earnings reports. Here's what nobody's telling you on CNBC. China has been preparing for this moment since 2008. While Wall Street was busy collapsing the global financial system and getting bailed out with your money, Chinese strategists were taking notes. They watched how weaponized finance works. They studied how dollar dominance gives Washington the power to destroy entire economies with sanctions. They learned the game, and now they're building their own casino where they control all the odds. The key date everyone's missing is 2026, not because of some apocalyptic event, but because that's when several carefully orchestrated Chinese financial infrastructure projects reach critical mass simultaneously. The digital yuan reaches full international interoperability. The Shanghai oil futures market hits a tipping point in actual crude settlement volumes. The cross-border interbank payment system, China's alternative to SWIFT, processes enough daily transactions to become genuinely viable for major trade partners. This isn't conspiracy theory. This is documented policy straight from Beijing's official strategic documents, if you're willing to read beyond the sanitized English translations your media feeds you. But there's more to this. The mechanism China is using is brilliantly simple, and it exploits the fatal flaw in America's financial imperialism. The US has spent decades using dollar dominance as a weapon, freezing accounts, blocking transactions, sanctioning entire nations. Every time Washington does this, they give countries around the world a powerful incentive to find alternatives. China isn't forcing nations to abandon the dollar. Washington is pushing them into Beijing's arms. Take Russia as the perfect case study. After the 2022 sanctions, Moscow was essentially expelled from the dollar system. Did the Russian economy collapse like the experts promised? No. They pivoted hard to yuan-denominated trade with China, started settling oil sales in alternative currencies, and accelerated their de-dollarization timeline by probably a decade. Washington's financial weapon created exactly the alternative financial network it feared most. Now multiply that dynamic across the dozens of countries currently under various levels of U.S. sanctions, or living in fear they might be next. Iran, Venezuela, North Korea. These aren't economic powerhouses individually, but collectively, they represent significant global trade flows. China is offering them a lifeline. Trade with us in yuan, settle through our payment systems, hold your reserves in our bonds. No Washington approval required, no political conditions, no lectures about democracy. The implication here is striking. By 2030, if current trajectories hold, roughly 25-30% of global trade could be settling outside the dollar system entirely. That might not sound catastrophic, but here's what the mainstream analysts aren't gaming out for you. The dollar's dominance is not a linear thing where you can lose a bit here and there without consequences. It's a network effect. The dollar is powerful because everyone uses it, and everyone uses it because it's powerful. Once that cycle starts running in reverse, the unraveling could be shockingly rapid. Think about it from a central bank governor's perspective in a mid-sized economy. Maybe you're running the monetary policy for Indonesia or Brazil or South Africa. Right now, you hold the majority of your reserves in dollars because that's what everyone does. That's what's liquid. That's what's safe. But every year, you're watching China become a bigger trade partner. You're watching yuan settlement options expand. You're watching other countries diversify their reserves without consequences. At what point does the calculation flip? At what point does holding 60% of your reserves in dollars start feeling less like prudent policy and more like putting all your eggs in a basket controlled by a declining superpower that might sanction you if you make the wrong political move? That's the tipping point Beijing is engineering. Let me show you why this matters. The dollar's reserve currency status gives America an extraordinary privilege. Economists call exorbitant privilege. The ability to print money and have the world accept it as payment for real goods. This privilege subsidizes the American lifestyle to a degree most people don't comprehend. It keeps interest rates artificially low, allows the government to run unlimited deficits without immediate consequences, and lets Americans consume far more than they produce. If that privilege erodes even partially, the economic adjustments required would be massive. We're talking significantly higher interest rates, reduced purchasing power, inability to finance deficits at current levels. The American standard of living would necessarily decline to match actual economic productivity. This isn't fear-mongering. It is basic math that the political class is desperately avoiding because the truth is politically toxic. China knows this. Their strategy isn't to destroy the dollar overnight. That would crash their own export economy and tank the value of their existing dollar holdings. Their strategy is gradual displacement, a slow-motion financial encirclement that builds alternative infrastructure piece by piece until one day you wake up and the dollar is just one currency among several, not the dominant force. Here's the bottom line. The digital yuan is the most sophisticated financial surveillance tool ever created, but it's also a genuine technological leap in monetary infrastructure. Beijing has spent billions developing a central bank digital currency that can settle cross-border transactions in seconds, operates 24/7 unlike traditional banking, and requires zero American involvement. They're not marketing this to Europeans or Americans. They know those populations are too wedded to the existing system and too suspicious of Chinese technology. They're targeting the global south, Africa, Southeast Asia, Latin America, Central Asia, countries that have been underserved by the dollar system, that pay high fees for international transactions, that face liquidity crunches because they can't access dollar funding easily. To these countries, China is offering turnkey financial infrastructure. Build your economy on our payment rails, settle trade in digital yuan, access credit through our development banks. And by the way, we won't lecture you about your domestic politics or threaten you with sanctions if you don't vote the right way at the UN. It's a compelling pitch. The Saudi question is the nuclear scenario everyone's whispering about, but nobody wants to say out loud. For 50 years, the dollar's global dominance has rested significantly on the petrodollar system, the arrangement where oil, the world's most critical commodity, is priced and traded primarily in dollars. This creates automatic dollar demand. Every country needs energy, therefore every country needs dollars. Saudi Arabia has been the linchpin of this system since 1974, but their relationship with Washington has been deteriorating for years. The Obama administration's Iran deal infuriated them. The Biden administration's human rights criticism offended them. Meanwhile, China has become Saudi Arabia's largest oil customer and has been actively courting Riyadh with massive investment deals. In 2023, the Saudis started openly discussing pricing some oil sales in yuan. Well, that was a warning shot. By 2026, 2027, if current trends continue, we could see the first major long-term oil contracts settled entirely in digital yuan. Not all of them, probably not even most of them initially, but enough to crack the petrodollar foundation. This is significant. Once oil can be routinely purchased in yuan, the automatic demand for dollars weakens. Countries that previously needed to hold large dollar reserves to buy energy can now hold yuan instead. The network effect starts running in reverse. But there's more to this. China isn't operating in isolation. They're building a coalition of the economically excluded and politically frustrated. The BRICS expansion is the visible manifestation of this strategy. Brazil, Russia, India, China, South Africa, now expanding to include Iran, UAE, Egypt, Ethiopia. These aren't natural allies in most respects, but they share one common interest: reducing dependence on a dollar system controlled by Washington. Together, these countries represent about 45% of global population and roughly 36% of global GDP at purchasing power parity. That's a big enough economic bloc to sustain alternative financial infrastructure. China provides the technology and initial liquidity. Russia provides energy resources and political motivation. The Gulf states provide additional energy and capital. India provides market scale and technological talent. Brazil and South Africa provide geographic diversification and resource depth. The Western financial media treats BRICS as a joke, a dysfunctional collection of disparate economies that will never cooperate effectively. And yes, there are serious internal tensions, particularly between India and China. But dismissing the alliance entirely is exactly the kind of arrogance that leads to strategic blindness. You don't need perfect cooperation to disrupt the dollar system. You just need enough coordination to provide viable alternatives at critical junctures. If a sanctioned country can route payments through intermediaries in this network, if trade can be settled in local currencies through currency swap agreements, if the digital yuan provides alternative payment rail, the system works well enough to erode dollar dominance even if it's messy and inefficient. The 2030 timeline is crucial because that's when China's Belt and Road infrastructure projects reach maturity across multiple continents simultaneously. Ports in Pakistan, railways in East Africa, power plants in Southeast Asia, telecommunications, networks in Latin America. These aren't just infrastructure projects. They're the physical foundation of an alternative economic sphere. Countries that owe significant debt to China for Belt and Road projects have a natural incentive to earn yuan to service that debt. China structures the deals to accept yuan payment, creating automatic demand. This is the same playbook America used in the post-WW period. Loan dollars, create demand for dollars, lock countries into your economic sphere. The difference is China is doing it with physical infrastructure instead of military protection. And in many ways, that's a more sustainable model. You can withdraw military forces if the politics change. It's much harder to unplug a power plant or dismantle a railway system. Let me show you why this matters. American power in the 21st century has rested on three pillars: military dominance, technological superiority, and financial control. The military is still formidable, but overstretched and increasingly expensive. The technology lead is narrowing rapidly in key areas. That leaves financial control as the critical remaining advantage. If China successfully builds alternative financial infrastructure that processes even 30 to 40% of global trade outside the dollar system, American geopolitical power takes a massive hit. Sanctions become less effective. The ability to freeze assets becomes less threatening. The leverage Washington uses to shape global policy weakens dramatically. This isn't about America disappearing as a power. The U.S. economy is still massive and innovative. But it's about the end of unipolar financial hegemony. Instead of one country controlling the global monetary system, you get a multipolar system with genuine alternatives. The implication here is striking. For the average American, this transition probably means a significantly lower standard of living. Not poverty, not collapse, but the end of the exceptional consumption patterns enabled by reserve currency privilege. Imported goods become more expensive as the dollar weakens. Interest rates rise as the government can no longer borrow unlimited amounts at artificially low rates. The trade deficit closes not through increased exports, but through reduced imports, as Americans simply can't afford to consume as much foreign production. The political establishment knows this is coming, which is why you see such desperate measures to contain China. The tariffs, the technology restrictions, the military posturing around Taiwan, these aren't random policy choices. They're reactions to the existential threat China poses to American financial dominance. But here's what the war hawks won't tell you. It's probably too late to stop this process through confrontation. The infrastructure is being built, the relationships are being forged, the alternatives are being operationalized. Short of actual war, which would be catastrophic for everyone, there's no reset button that restores dollar monopoly. The smarter play would be negotiating the transition, maintaining dollar relevance in a multipolar currency system, and adjusting the American economy to operate without exorbitant privilege. But that would require political honesty about the trade-offs, and we both know that's not happening in the current environment. By 2035 to 2040, the global monetary system will likely look radically different from today. Not a yuan monopoly replacing a dollar monopoly. That's not what China is actually aiming for, despite the rhetoric. Instead, think of a fragmented system where different economic blocs use different currencies, where digital central bank currencies enable direct settlement without intermediaries, where the dollar is still important but no longer dominant. Some economists call this the end of monetary hegemony. Others frame it as currency multipolarity. The terminology matters less than the fundamental shift. No single country will be able to weaponize finance the way America has for the past 70 years. There's actually a historical precedent for this. The world before World War I had British sterling as the dominant reserve currency, but French francs and German marks played significant regional roles. Gold provided the underlying anchor. The system was multipolar and relatively stable until political tensions exploded into war. We're potentially returning to something similar, except instead of gold anchoring the system, it'll be a messy competition between different fiat currencies backed by different economic blocs. The digital infrastructure makes this more feasible than in previous eras because you don't need physical currency flows, just functioning payment systems. China's advantage is they're building this infrastructure proactively while the US is reacting defensively. The digital yuan is operational now. The cross-border interbank payment system is processing real transactions now. The currency swap agreements are signed and functioning now. Meanwhile, America is still debating whether to even research a digital dollar, hamstrung by political fights and financial industry lobbying. The implication here is striking. Technology advantages are temporary, military advantages are expensive, but infrastructure advantages are durable. Once China has built the payment rails, established the clearing systems, trained the workforce, and integrated the technology into partner countries' financial systems, that infrastructure becomes very sticky. Countries don't casually switch payment systems. The switching costs are enormous. This is how Beijing is thinking, not in election cycles, but in decades. They're willing to subsidize these systems at a loss for years because they understand the strategic payoff. Once enough global commerce flows through yuan-denominated infrastructure, Chinese influence becomes automatic. You don't need to explicitly control countries. You just need to be essential to their economic functioning. The 2026-2028 period is the danger zone for the dollar, because that's when several trends converge. The digital yuan reaches international maturity. Belt and road projects start generating yuan-denominated returns. The BRICS payment system goes live. Saudi Arabia potentially diversifies its oil pricing. U.S. government debt reaches levels that start genuinely concerning international holders. Any one of these factors alone would be manageable. All of them hitting simultaneously creates a potential cascade where dollar demand weakens, which triggers more diversification, which weakens demand further. The Fed would have to choose between defending the dollar with catastrophically high interest rates or accepting devaluation and inflation. Neither choice is good. High rates would crush the debt-dependent U.S. economy and potentially trigger a severe recession. Accepting devaluation would erode purchasing power and potentially trigger a crisis of confidence in U.S. assets more broadly. The Fed has navigated difficult trade-offs before, but this one might be impossible to manage cleanly. Here's the bottom line. China doesn't need to convince the world that the yuan is better than the dollar. They just need to provide a viable alternative for countries that Washington has given strong incentives to diversify. Every sanction, every act of financial warfare, every political condition attached to dollar access, these are self-inflicted wounds in the currency competition. Beijing is patient. They're building the infrastructure, expanding the network, and waiting for Washington to keep making tactical mistakes that serve China's strategic interests. The beautiful irony is that American financial aggression is the best marketing China has for alternative systems. The scenario where the dollar completely collapses is unlikely. The U.S. economy is too large, too innovative, too networked into the global system for total irrelevance. But the scenario where dollar dominance erodes to the point where America can't finance unlimited deficits, can't weaponize finance without consequences, and can't sustain current consumption patterns through monetary privilege. That scenario is not just possible. It's probable given current trajectories. What this all comes down to is the transition from American financial hegemony to a multipolar monetary system is already underway. The question isn't whether it happens, but how fast, how disruptively, and whether the United States can adapt to a world where its currency is important but not dominant. China has spent 2 decades preparing for this moment. They've studied America's playbook, identified the vulnerabilities, and built alternative infrastructure with remarkable strategic discipline. Between 2026 and 2040, we're going to see whether that preparation pays off. And if I'm being honest with you, and I always am, unlike the experts protecting their institutional positions, the odds favor Beijing in this particular competition. Not because China is morally superior or economically more sound, but because they're executing a coherent strategy while Washington is reactive, distracted, and politically paralyzed. In geopolitics, as in markets, strategic focus beats tactical brilliance every single time. The dollar era is ending in 2026, but 2026 is when the post-dollar era starts becoming visible to people who aren't paying attention. By the time the mainstream financial media acknowledges what's happening, the transition will be too far advanced to reverse. That's how these systemic shifts always work. Invisible until they're inevitable. You can choose to prepare for this reality, or you can listen to the institutional voices telling you everything is fine, but you already know which choice serves your interests versus theirs.